Friends, clients, and colleagues. This is Rich Siegel and Carl Mariner with ARQ Wealth Advisors, and today is Wednesday, June 16th, and it's time for a market update. Let's launch the presentation, Carl.
All right. Should be coming up in just a second here.
All right. Boom, there we go. So this is going to be a 6-chart market update. I'll do 3. Carl will do 3. Should take about 10 or 12 minutes or so. Take a second to read our disclaimer language for the compliance folks. You can pause it and read it if you want. And here we go. So I'll do the first 3. The first thing we want to focus on is inflation. And this chart goes back to the 2018 timeframe. You see this gigantic spike in inflation in the 2022 range, 9.1, the highest in 40 years. And as we all recall, the Fed raised rates dramatically to beat down inflation. Mission accomplished for the most part. And look all the way to the right, you can see the green spikes there. And it looks like inflation has risen a little bit from high 2s to high 3s. And the culprit, the green, is energy. No surprise. That has to all do with the military war skirmish in Iran. And now that seems to be hopefully over, we expect that to come down in fairly short order, and inflation getting back down towards that, high 2s to low 3s number. And this dovetails well with today's Fed meeting. So let's change the slide. So this was Kevin Warsh's first Fed meeting. He's the new chairperson. I watched bits and pieces of it. It seemed like he was very measured and articulate. And the takeaway, the market reacted negatively. Stocks and bonds went down as well, and rates went up a little bit. And that's to be expected. You have a new face person of the Fed. The market likes to test the new chairperson. And I think the message, the takeaway that we really got from that was, hey, we have some dissent on the committee. It does not look like rate cuts are in the cards anytime soon. In fact, more likely we could see a rate hike. The poly markets, betting markets are showing, for right now at least, is an 80% chance, 79.8% chance of no Fed cut or hike by the end of this year. So that's kind of the baseline. I think it really all depends on what happens with energy prices. If they stay elevated, we might see a rate hike to offset that newer, higher inflation. So I think they're going to be data dependent. Again, the Fed has a dual mandate, right? Price stability, that's inflation, and full employment. And employment is right in the range that we want to see, like a 4.2%. Okay, next slide, please. It's my final slide. We have 2 charts on here. It's a twofer. And the economy in a nutshell, unemployment, quite stable. It seems to be right around that 4.2 range. We got as high as maybe 4.5, nowhere near recession levels. Certain sectors have been hit harder than others, but overall, most people are working that want to work, and we are a consumer-driven economy, and that bodes well for our GDP, which, by the way, second bullet point, GDP forecast now for Q2 has risen back up to 3%. So economic growth in the U.S. is actually pretty robust, pretty decent. Inflation, definitely higher, but we think it should start moving lower. And hopefully that will translate into gas prices at the pump pretty soon, because that's been a stress for a lot of folks. And the last thing I'll say on the bottom here is a chart, the blue bar chart, is the Institute for Supply Management, ISM survey. This is basically our manufacturing sector. And what you'll notice is the 50 number on the right, if you draw a line across that, basically for the last few years,
Sorry about that.
Thank you. Over the last few years, almost all those bars were below 50, indicating a contraction or softening of the industrial base, the industrial sector. Anything above 50 shows expansion. And this is what Trump ran on, right? Look at the number, 50, 5 months in a row, well over 50. So this is good for industrial stocks and material stocks, basic materials, some commodities. Um, it also indicates when you have a long period of below trend or contractionary manufacturing and then a quick rise, that we're usually in a mid-cycle economy, meaning we're not at the end of the expansion. And that also translates well to the last chart that I'll cover, the yellow bars. Since 1926, the average length of a economic expansion is 61 and a half months. So let's just call that 5 years and change, right? Look at the last four. The average has been 104 months. It's like 8 years. So it seems like in recent decades, the economy grows for a longer time, has these like waterfall drops, like what happened during COVID and what happened during like 2022, with the exception of the great financial crisis that lasted about a year. Um, I think the increased length of expansions has to do with the Fed having more tools in the toolkit, more monetary policy ideas, and also some fiscal policy. So the bottom line is we're 73 months into this expansion here, but the average for the last several decades has been 104. So if that's the case, if these charts say that we're mid-cycle, we should have 2 to 3 years to go left in this economy before we see some type of recessionary activity. So overall, the takeaway here is pretty strong economy overall. The metrics are lining up pretty well. And I think a lot of that has to do with hopefully the end to this military conflict in the Middle East and oil prices coming down, which in turn should bring inflation back down. Carl, take it away.
All right. Thank you, Rich. I'm going to cover a couple of charts about the markets in the last few minutes here. The first one, we're going to take a broader look at what's happening, given the environment that Rich just described, what's happening in the bond market, what's happening in the stock market. And so we try to summarize that in one chart here. This first blue line is the return of the U.S. aggregate bond index. So looking over the last 6 months, how have bonds done in general? It's been fairly muted, but positive. So about 0.5% positive return from the broader bond market up through the close of yesterday's market. And part of the reason is bonds are yielding higher, but in this inflationary environment that Rich just described with the Iran conflict, one of the things you often see is bond yields go up. When yields go up, prices go down. And so that kind of counteracts some of the yield that you're getting in the bonds. And so it leads to a more muted return. If you've been following our readings or some of our past commentaries, we kind of anticipated some potential risks coming into the year. We were a little bit shorter in duration, so we had less interest rate sensitivity. And so as a result, across our firm, clients on average are up about 2% for bonds. So pretty meaningfully above the target there. We look at what's happening in the stock market. This green line is the S&P 500 over the last 6 months. So you can see the beginning of the Iran conflict all the way up through today. The US stock market is up almost 10% in the first 6 months or so of the year. So a pretty strong start to the year. But I would highlight, we've talked a lot about the broadening out of markets, getting return from other segments of the equity market, not just the large cap US tech driven names. And so just highlighting so far year to date, the all country world index, that's international stocks, everything not in the US, what's happening there? Up about 15%. The US small cap, Russell 2000, up about 19%. And so this theme of having a more diversified portfolio has really benefited our clients. If I look across our firm, on average, clients are up about 13 to 15% on equities versus the S&P. So if we're able to get to outsized returns with lower risk, that feels like a pretty good spot. We're pretty happy with how that's gone for the year. Rich, any thoughts to add to that one?
Now, it's just gratifying to see that our clients are up close to the entire return of the S&P 500 with just over half the risk. And that's just because of what you said, because of the exposure to the outperforming areas, specifically emerging markets and small cap stocks.
That's it. I'm glad you brought up emerging markets. An incredible start to this year for emerging markets. If we look at the last 12 months, Emerging markets are up 50%,
It's wild.
50% in the last
Yeah.
12 months. This first chart on the left just shows the outperformance relative to US stocks. It's absolutely incredible to see. I think we had some anticipation or expectation that we might get more diversified sources of returns. Emerging markets is an area that we were particularly focused on how we wanted to get that exposure. I don't think any of us predicted that type of outsized returns, but certainly happy to be a little bit overweight in the space. Rich, what other thoughts would you add to this one?
No, it's interesting. In my career, it seems like the emerging markets sector as a whole seems to really outperform in fits and starts. So if you have the stomach to have a slice of the pie in emerging markets, you can really enjoy these returns. And this year is a perfect example of that.
Yeah, great point. Wouldn't be a market update this week if people weren't talking about SpaceX. So I thought it was worth sharing a little bit of context here. And I always like to put context around an event like this SpaceX IPO. The size and magnitude certainly has been the talk of the industry. I'm showing two charts here. And the first one, just to give a little sense of the scale for the market cap of SpaceX. In red is the market cap of SpaceX. In blue is the market cap of the entire rest of the aerospace and defense sector. SpaceX is on paper worth more than the rest of the entire industry. It feels pretty astounding, particularly given the second chart, which draws some comparisons to some other large companies with similar size market caps, Microsoft, Amazon. But when you look at the sales and the net income of those businesses, you see fairly large numbers. SpaceX recent sales, $19 billion. So a fraction of what a Microsoft or Amazon at a similar size is getting. Also, interestingly, net income negative $9 billion. And so, not at all to say that this company will not grow into the market cap. Betting against Elon historically has not been a great move as an investor. He has tended to have a similar playbook in the past with Tesla, but just acknowledge the sheer magnitude of a company trading at a $2.5 to $3 trillion market cap on $19 billion of sales is pricing in a tremendous amount of optimism. Rich, any other thoughts?
Yeah, I would just say I agree. I think a lot of the euphoria that's built in is because of its space and the telecom aspect and the AI aspect of the company. We've seen this story before with Amazon, for example. They ran for well over a decade unprofitable, right? Same thing with Tesla, Amazon. So strap in because this SpaceX stock is not going to go straight up. It's probably going to crash at some point, then go back up again. It's going to be all over the place. For those who think they missed it, they really didn't. We'll have an opportunity, and most of the funds that you own will have a sliver in SpaceX coming soon. I think the S&P 500 is going to wait about a year to add it, but we've seen most of the global benchmarks like the FTSE and the Morgan Stanley indexes, and even the NASDAQ 100 will be adding SpaceX, I think, by the end of this month.
That's right.
Mm-hmm.
That's right.
Right.
To Rich's point, we've seen this in the past with other large IPOs. Facebook comes to mind, where IPO price happens. You see a lot of price action early. 6 months, 12 months later, often what we see is a retracement of some of that pricing. And so our view is not a negative on the company at all. It's just being careful around the irrational exuberance that sometimes happens with an IPO. We want to be thoughtful about the assets we're buying and the prices we're paying for.
Yeah, I can't remember the actual numbers, but I remember watching Facebook launch years ago. I think it was in the 20s. Within minutes, it was at 42, and a few weeks later, it was at 18. Right. So, not to say that's going to happen here, but try not to feel like you missed anything because there'll be plenty of opportunities over time in volatile stocks like SpaceX. I think that's it. We covered a lot. Hope you enjoyed, and we'll speak to you soon.